Welcome to the Jill on Money Show. It's Saturday, July 6th, and I know you're probably enjoying a great weekend. Today we are airing the second part of our interview with Barry Ritholtz. He is really a legend in the industry. He's written blogs. He's been on the air in various financial outlets. He has been someone who I have really admired for so long. Today we're going to focus on what was Barry doing in the lead up to the financial crisis. As always, if you've got a question, a comment about something Barry talks about in this interview or anytime, just go to our website, jillonmoney.com, and click the Contact Us button. We'll get you on the air. So today, part 2 of our interview with Barry Ritholtz. Get me from 2002 to 2008. What's happening in those years of expansion, recovery from the dot-com boom and bust? What's happening in the life of Barry?
So market makes a low October 2002 and March 2003, and I'm writing about this, saying, hey, you know, anytime you see, I'm a buyer anytime the stock market, like the U.S. stock market, is cut in half, NASDAQ down 82% peak to trough, you want to own this. And so I'm trying to explain while I'm doing research and using, here's where law school is really helpful. Lawyers are generalists. You have to be able to argue every case. You don't know which part of, even if you're in, you know, white collar crime. There's a million subjects in white collar crime. Yeah. So you have to learn the area, learn the history, be able to talk about it intelligently. And with finance, you have to be able to talk about the math of it a little bit. And my secret sauce was I brought in a little of the behavioral finance to it. Hey, let me explain why you're doing this wrong. Let's explain why you're doing this wrong and why your brain is working against you.
Okay.
And so I start writing about this subject. It's on Typepad for a good couple of years, and it starts getting picked up. I'm quoting in the Journal. I'm quoting in Barron's.
Now, how did that feel when that first started happening? Quite a validation, right?
Yes, there's a yes, but. I'll come to the but in a little bit. I come back from being away for the weekend, and back in the day when you would walk into your house and the message machine would say 43 messages. What the hell is this about? All these calls out of the blue. Dude, Kudlow mentioned you on the show on Friday. There was a quote in the Wall Street Journal. Maybe this was like late 2002, and I said, hey, you know, not only does it feel like the market's bottomed, but there's a sense the train is leaving the station and investors want to get on board. And Kudlow read, that's a Wall Street Journal quote from me. Kudlow reads it on the air. And so I ran him just a polite note. Hey, thanks. I got a ton of radio silence. A few weeks later, he says something. Now I'm watching the show a little more carefully. He says something, and I'm like, oh, I just wrote about that last week. I send the piece in, radio silence. I'm like, all right, you know, they're busy. The third time it happens, an email comes back. Hey, get this guy in the show. He seems to know what he's talking about. So I start doing the show, and I do the show. You know, it started out once a month, and then it was twice a month, and it was once a week.
Okay, wait a second. Hold on a second. So are you you're done? Are you still head of research at this place, or are you
I'm
just
chief
Barry?
Market strategist at Maxim Group.
Okay, and you still have that title. And are they paying you to go on CNBC, or are you just showing up as a guest?
No, I'm a guest. They want me to go. They want me to get the
and
firm's
Maxim's
name
happy
out.
Is because your name's out there. That's awesome.
The first day I do the show, I walk into the boardroom the next day. Round of applause, standing O. It's like, wow.
All right,
because everybody wants to have social proof and credibility, and to people selling a product. As I've learned over the years, that social proof is valuable.
So that happens all through the 2000s. Life is good. So let's go to the beginning of 2007. What are you doing for work? What's going on with the blog? Where are you appearing on TV?
Right.
We are starting. I only know this because just these dates for people like you and me are sort of seared into our head.
Right, substantial.
Right? So, you know, March of 2007, Bear Stearns has 2 hedge funds that go broke. It's like the canary in the coal mine, right?
So 3 things are going on at that time. First, I've been writing and jumping up and down and screaming about subprime and derivatives and housing. And I told you what my dad did. My mom was a real estate agent, so I probably focused more on real estate than the average person on Wall Street. And I had 3 charts that I showed over and over and over again. Median price of income to median price of house. For 100 years, it's like this. Then it's 3 standard deviations above normal. Cost of ownership versus cost of renting. Same thing.
Yep.
And the last is the value of all the housing in America versus GDP. Same thing. Like all three charts. And it's like, hey, either everybody's salary is going to double or stocks are going to come down appreciably. And I read this white paper by Reinhardt and Rogoff that looked at 5 crises.
Yeah.
I never can remember which ones they were. It was Mexico, U.S. in 29, Japan, Finland. The 5th one always escapes me. Anyway, the average the average damage during a financial crisis, markets drop 40 to 50%, but housing drops 30%. And if you recall, in the mid-2000s, there was a lot of chatter. Housing prices never go down.
I know. Okay, can I tell you?
By the way, if you lived in New York in the 80s and 90s, that was nonsense.
Baloney. I remember this was because I was the chief investment officer of my RIA at the time, and I remember in 2007 that a guy said to me, well, based on our models, we're really comfortable with these positions. Right. And I said, your models are not right. I'll tell you that right now. Like, there's no way that that's right, that you're going to, nothing ever happens, therefore it never happens. That's baloney. And it's funny that you should mention that because during the COVID crisis, for a piece that we did on CBS Sunday Morning, I had Ken Rogoff on. Mm-hmm. And I asked him, how does this compare to your financial crises, right? So it's Carmen Reinhardt and Ken Rogoff who wrote who wrote this pretty seminal book that is very impressionable.
Based on that paper,
right.
The book was 800 years of financial folly.
Right, and it was
this time is different.
Right. And he said, this time is different because, as always, we know we've never been through a once in a century pandemic. Right. He said, but the result of going through this pandemic and these other crises is that what we can tell you is that it is going to resolve. We just don't know how. And you see, he's like, I'm an economist, so I can tell you it will be okay. I just don't know when, and you might feel a ton of pain between now and then. And I thought that was his take being interesting, which is he's sort of a historian also.
He's very much a historian.
Right? And so
literally the subtitle is 800 Years of Financial Folly.
And from his point of view, the difference of this crisis, the pandemic crisis, and because I would say, how does this compare to the financial crisis? He said, well, it's not really the financial institutions that are coming into this period, right? And that came into this period doing bad stuff. Mm-hmm. It is we're all in this together. We're all going to get out of this together. We don't know how it's going to,
Well, most of us. Some of us didn't make it.
Exactly. Financially, not physically. But I do think there's something to be said for looking back in time and saying, of course, it's not going to be repeating, stanza for stanza. We're not going to have that. But the idea that history doesn't repeat itself, but it does rhyme, that we do have a way that you could look back with your charts and you could say, there's something wrong here. There's something different. And also the idea that the industry was so in love with its position.
The line I used to use on people when someone would say, well, our models don't allow for house prices to go down. And look, we're not even talking about 1929. You just had to go to 1989 to know that home prices dropped. George Box, a professor of statistics out of the UK. All models are wrong, but some are useful. And a model is just an artificial depiction of the universe. And if, you're off by a little bit, well, in the real world, it's going to be off by a lot. So I mentioned, so that was one thing. I've been writing about that. The second thing of 3 things that happened is I read that white paper on 5 crises, and I kind of say to myself, hold the stock market part aside. Let's think about if real estate that supposedly can't lose value drops 30%, what would that mean for the market? And I didn't have the patience to do all 500 stocks in the Dow, but I said, let's reverse. And at the time, I'm publishing at thestreet.com.
Okay.
Let's reverse engineer the Dow and figure out that if real estate drops 30%, what will this mean for the banks, for the consumer companies? And and let's be blunt, there's a lot of spitballing. You're kind of ballparking things. At the time, the Dow was approaching 13,000, and I reverse engineer a number of 9,800. But say, and here's where the behavioral finance comes in, hey, if we drop from 13,000 through 10,000, I think that causes a 3,000-point panic. And I think we end up around 6,800. this isn't a forecast. It's not a prediction. The only time that's mentioned is in like the last paragraph. I think it was 2 or 3 serialized in 3 sections. Nobody wanted to talk about the analysis. They didn't want to talk about Reinhardt and Rogoff. They didn't want to talk about real estate.
6,800.
That's all anyone wanted to talk about.
Wasn't it 65.47 was the bottom?
61 and change on the Dow.
All right. Fact check that, guys.
So I get invited to do the annual Business Week forecast. And I say, listen, I think this is, by the way, this is like late 06. Listen, I spent a lot of time studying forecasts and analysis, and all these forecasters are terrible. They're all wrong. A year is way too long. You want to forecast out a few weeks? Okay. You want to forecast out a decade? You have a trend. A year is long enough for random events to happen, right? And my current favorite events is nobody was forecasting the invasion of Ukraine.
Yeah.
Right before that, certainly nobody in 2019 was forecasting a global pandemic. And last year, no one was forecasting, the whole Israel-Gaza war. So events are a year's too long a period to really make a reliable forecast. So I'm explaining this to the editor of Business Week. And I'm like, let's do some counter-programming and talk about why forecast is folly, which was a column I had written, and why all these things are unreliable and investors shouldn't base their portfolios on it. And I'll never forget, the answer comes back, and this was before Bloomberg owned them, so I could say this without anybody calling me up and yelling at me. Listen, it's a big double issue. We sell a ton of advertising. Do you want to be in it or not? And I was like kind of offended by that.
Yeah.
So I'm like, sure, here's my number. 6,800 on the Dow.
Yeah.
And whatever the proportionate numbers, I think it was like 720 on the S&P. I don't remember what the NASDAQ was, but it was like a 50%. Wherever they were,
Yep.
they're pretty much in half. And so the numbers come out, and there's this giant cluster over here, and then down around the floor is Barry. And Kudlow immediately says, let's get you on the show, and proceeds to just excoriate me. Why? And I explained, listen, it's not a forecast. It's sort of we're sort of wargaming what happens when, not if, when housing suffers its setback, which had already begun. So housing peaked in 06. By 07, it's already rolling over. And for about a year, I absolutely, the wrong type of goat. And I remember walking back from a hit on CNBC in the Madison Avenue studio with Peter Bookvar, whose office was not too far from our office. And I'm walking back, and we both talk about the risk from derivatives and the risk to subprime mortgages. And this is 07, and the market's still going higher.
Yes.
And I wasn't saying, hey, sell everything now. I was saying, when this rally ends, look out below. The anchors laughed at us. I'm not exaggerating. They LOL out loud on TV at us, and we're walking back from that, and I'm like, hey, either we're hallucinating and wrong, or everybody's in for a really big surprise. Like, the consensus that it wasn't that I don't agree with your analysis, and here's the reasons why I think your fundamental premise is flawed. It was just, you guys are crazy. That can never happen. It was hodlers to the moon before that even existed.
And so, of course, you're proven right. But now I want to know, how is it?
Proven right in a weird way.
Well,
I'm on vacation. My wife is a teacher. We can only go on vacation on school holidays.
Okay.
When I'm away, we go through Dow 6,800. And I had said to a buddy a few months beforehand, when we broke 10,000, hey, if we get anywhere near 6,800, don't let me be that putz who doubles down and says 3,400, right? Like, I want you to slap me upside my head if I do that. So I get home from vacation, and of course you're like exhausted. And that Monday I get a phone call. This is your reminder. You told me if we got anywhere near it. And I'm like, I'm halfway done writing this up. So I write up a piece, cover your shorts and go long. We're looking for the mother of all bear market rallies. Out that goes. Immediate phone call from Henry Blodgett of Business Insider and Yahoo. Hey, you want to come on TV and talk about this? You've been the biggest bear on Wall Street. Let's go. So I go on TV and say, look, every indicator we look at is pinned as, like, remember the old VU meters? That's where us oldsters like kids don't know that.
Yeah, of
Everything
course.
is pinned in the red. Like down 50% is a great entry point, but I've just never seen this level of bearishness either in my experience or in the history books. You got to buy them here. And I went from this guy's always bearish, what an idiot. The tragedy of Yahoo is all the comments are gone. And to this guy's a permabull, he doesn't know what he's talking about.
So we're in March of 2009?
The day before the market bottomed.
All right.
This goes out on Yahoo. It gets picked up by the New York Times and the Wall Street Journal. And at the time, the partners I'm working for are not happy when I would go on TV and say, look, that timing was just dumb luck. You could ask me the same question a month
No, you're a
earlier.
genius.
A month later, no, nobody really knows exactly. Hey, listen, there's a reason we don't sling $4.5 billion around on my gut. To this day, I can't tell you genius or lucky, maybe 80-20, like 80% lucky and a little bit of smarts.
All right, we'll take it.
But certainly not a reliable process to manage actual money with.
We've got one more episode with Barry Ritholtz. We'll air that tomorrow. If you've got a financial question, you've got something that percolates because of the conversation with Barry, just give us a holler. Go to JillOnMoney.com, click the Contact Us button. Don't forget to check the box if you'd like to join us on the air live. And as always, we are so grateful that you listen every single week, especially on a long weekend. Maybe you're catching up. Maybe it's Monday. Who knows? We're very grateful regardless. You can subscribe to us on the Odyssey app or wherever you find your favorite podcasts. And of course, lift someone up. Change your work, change your wealth, change your life. Thanks for listening. We'll talk to you tomorrow.